If you are a trend trader and prefer the swing trading, I'm sure that you face the same problems I was facing when I started trading. The main struggle as traders is to exactly pinpoint the market entry in order to catch the next big move. But what if you developed a simple swing trading setup that would generate high probability entry signals? Hey traders, this is Marius, and if you stick with me for a few minutes, I will share with you a simple and an easy swing trading strategy that will improve your trading results. The core of this system relies on divergences between the price and the stochastic indicator in the direction of the prevailing trend on the market, indicated by the 200 EMA. Let's dive right into this strategy and see how it works. Here's the first rule of this strategy. We need to spot divergences between the price action and the stochastic indicator. If you are a trend trader, divergences should be one of your most important tools because a divergence signals momentum coming into the main trend, suggesting a possible continuation in the prevailing direction of the market. As you probably know, there are two types of divergences, regular and hidden. A regular divergence involves higher high prices and lower indicator values during an uptrend, and lower low prices and higher indicator values during a downtrend. When this happens, that's an indication of market exhaustion, a possible sign of market reversal, or at least a short-term correction. A hidden divergence is a visual non-confirmation which involves higher lows of the price but lower indicator values during an uptrend, and lower highs of the price but higher indicator values during a downtrend. A hidden divergence signals a continuation move in the direction of the prevailing trend. That's why if you prefer to take positions in the direction of the main trend, the hidden divergence can generate some pretty accurate signals. For spotting divergences, you can use many tools, but I prefer to use the stochastic indicator. Now, here's the key to our system. We don't trade all the divergences. During strong trends, the stochastic will generate divergence after divergence, and most of the signals will probably fail. Look at this Bitcoin chart, and as you can see, the price was in a strong upward trend, and the stochastic indicator generated several divergences, but most of these signals were false. That's a wrong approach in what concerns trading the divergences. We have to be smart and filter this technique in order to eliminate false signals. Now, here's the second rule of this strategy. We'll establish the main trend with a 200 period exponential moving average, and we only trade divergences in the direction of the main trend. Also, I only trade on the hourly, on the 4 hours, and on the daily time frames in order to reduce the market noise and filter the bad signals generated on shorter time frames. Here's how we take signals with this swing trading setup. When the price trades above the 200 EMA, we consider taking only long entries. When the price trades below the 200 EMA, we consider taking only short entries. We search for divergences between the stochastic indicator and the price only in the direction of the main trend indicated by the 200 EMA. If the price trades above the 200 EMA, we search for divergences on the lower side of the stochastic. And if the price trades below the 200 EMA, we search for divergences on the upper side of the stochastic. Very important, we are not interested in trading divergences that signal reversals, possible pullbacks, or counter-trend positions. Here's the pound dollar on the 4 hours time frame. We determine the upward trend with the 200 EMA, and we start searching for divergences on the lower side of the indicator, and we only consider to go long on the market. The first signal was a buy entry after a hidden divergence around the 200 EMA. Observe how the price was making higher lows, but the indicator was making lower lows. The The second signal was a buy entry after a classic divergence, also around the 200 EMA. See how the price is making lower lows, but the indicator makes higher lows. The third opportunity was generated after a classic divergence, also around the same 200 EMA. The fourth signal was also a classic divergence. If we look at the chart, we see the price making lower lows, but the stochastic making higher lows. The fifth signal was a hidden divergence. Observe how the price was making higher lows, but the indicator was making lower lows. The sixth signal was also a hidden divergence, with the same setup as before. The market price making higher lows, but the stochastic generated lower lows. As you can see, we ignored all the signals offered by the divergences on the upper side of the stochastic, as we are in a strong upward trend. Let's look at this gold chart also on the 4 hours time frame. We established the downward trend with a 200 EMA, and we start searching for divergences on the upper side of the indicator this time. The first signal was a short entry after a hidden divergence. Observe how the price was making lower highs, but the stochastic was making higher highs. The second entry was a short signal after a classic divergence. See how the price is making higher highs, but the indicator is making lower highs. The third opportunity was a classic divergence around the 200 EMA. The fourth signal was also a classic divergence. If we look at the chart, we can see the price making higher highs, but the indicator making lower highs. The fifth signal was a hidden divergence. Observe how the price was making lower highs, but the indicator was making higher highs. The sixth signal was a classic divergence. The price was making higher highs, but the stochastic was making lower highs. As you can see, we ignored all the signals offered by the divergences on the lower side of the stochastic, as we are in a strong downward trend. The trick of this strategy is to determine the main trend with the 200 EMA and only take positions in the direction of the trend. So we don't chase all the divergences that occur on the chart. We only trade the ones with a higher probability, meaning the ones in the direction of the main trend. If you are a trend following trader, you should train your eyes to spot the divergences on different charts. Please keep in mind that this system is more reliable when you are using higher time frames. A signal that is produced on the 4-hour or on the daily chart is more reliable than a signal produced on the 15 minutes chart. A divergence is more reliable on higher time frames because the market does not move as fast and is easier to define trends. By using higher time frames, you'll see the patterns developing and you'll have time to make the correct decisions. Test this strategy on your charts, and I look forward to hearing from you in the comment section about your results. If you got any value from this video, please consider subscribing to this channel and give us a like, as it would help us to grow our channel in the future. Until next time.